Welcome, everyone. Thank you for joining us today. I'm 𝗖𝗣𝗜 Biniaz. I'm joined by 𝗖𝗽 Benesocky. Welcome, �ey𝗽.
Thank you, August. Hello, everybody. Thank you for being here today. Today, we are joined by 𝗖𝗽 𝗖𝗽. He's the president of 𝗖𝗽 Investment Group, where he manages a group of over 1,500 investors who seek passive managed cash flowing investments in real estate and businesses. So welcome, 𝗖𝗽.
Welcome, 𝗖𝗽.
Thank you for being
here. Thanks, guys. Thanks for having me on. Really appreciate it.
Of course.
Wonderful. 𝗖𝗽, we're just going to start off. Why don't you go ahead and tell the viewers about yourself and about your background?
Sure. Yeah, it's actually nice to be talking to someone in Canada because I've been on like a lot, probably over 100 podcasts, but I think this maybe it's the second one I've been on in Canada, I think, ever. So, and I say that because I'm originally from Montreal. So, I'm from Montreal. I lived there actually for half of my life. I left there in the year 2000. Moved down to the US. So it's about half split now, half in Montreal and half in the US. I've been in Los Angeles for almost all of that, which is where I am right now. And my quick story is that I became a passive cash flow investor starting in 2002 after the dot-com crash. And for me, it was really about how do I get more predictability for my retirement account investing outside of the stock market after the dot-com crash, like all the volatility of it going up and down 30% in a year. And I just was worried about the predictability of where my retirement account would go in like 10, 20, 30 years. And so I started focusing on more kind of low risk passive cash flow for more predictability. Really, that was what I was looking for. And I've continued to have the same focus until today. It's been about 19 years later. The cash flow actually ended up getting me out of the corp world back in 2007. So I've been a full-time passive cash flow investor now for about 13 and a half years, but investing in these types of opportunities since 2002, which is about 19 years. I am also the co-founder of something called For Investors by Investors, which is public real estate meetings in Canada. We're a nonprofit. I started that and co-founded that in 2007, just to a solution to like, where can you go to public investor meetings without getting a sales pitch potentially? Like our goal is to just break even on the cost of the venue. We became, over time, the largest kind of series of what I call public and non-institutional real estate meetings in California. I haven't checked, honestly, in a couple of years, 2-3 years. We have over 30,000 members, probably more than that now in that. And I'm also an advisor for Realty Mogul, which is one of the largest US crowdfunding websites here in the US. I have an MBA from the Wharton School or University of Pennsylvania, which is why I originally came down to the US when I left. What else can I tell you? I'm very big into cash flow. That's my thing. And so I definitely love real estate. It's my favorite asset class, but I invest in other stuff outside of real estate too. So that's the quick background.
Great, wonderful, awesome. And you know the great thing about having you on here today, 𝗖𝗽, is that you transitioned from your business to be a full-time, initially passive investor in real estate. But now this is, I believe, is your full-time business. And it's great to kind of see that transition and kind of walk through your journey.
Yeah, absolutely. And I want to clarify that I am a full-time passive cash flow investor. So I don't consider myself an active passive cash flow investor only because I don't want to confuse the terms, because active and passive are two very different things.
Could you explain the term full-time passive cash flow investor? If you could.
Sure. So when I say I'm passive, what I mean is that my job is all the work I do is upfront. So I'll take an opportunity, evaluate, decide if that's actually where I want to invest. As soon as I've sent in my money and paperwork, all the rest of the work is up to the actual sponsor that's actually, or the manager that's managing the product or the project. So I'm not going and buying anything actively myself. I don't take direct title to anything myself. I'm not managing anything myself. And in fact, in my opinion, it's subjective, but in my opinion, if you go buy 10 single family homes for rentals, let's say, which is very common to do in the US and probably somewhat in Canada too, if you own those houses directly and your name's on the title and you have the mortgage and you can hire and fire the property manager, you can refi or sell the property anytime you want. To me, you're active, even though some people would say, no, I'm passive because I have a property manager managing everything, right? To me, you're still active because if there's a bill to be paid, if there's a toilet that has to be fixed, if there's a tenant you have to decide on, you're making all those decisions. Whereas what I do is do all my due diligence up front, and then all those major decisions are made by the manager on an ongoing basis. That's the expert in that asset class. So that's why I don't want to confuse active versus passive. I think it's a very important delineation. And I think that for anyone who's relatively new out there, my suggestion always, and I'm not a financial advisor, investment advisor, accountant, or attorney, so it's all just my perspective as an investor here. But my suggestion is always to, if you're just starting, make sure that whether you're going active or going passive, it's the right personality fit for you. Because some people, like I tell people as a passive investor, I give up control in exchange for diversification, right? I also get to leverage people's time, credit, all expertise in certain asset classes, everything else. But to me, it's the trading control for diversification. So I can spread my money across a lot more things, but I'm giving up control, and my small little vote is only a small percentage of the whole deal. So I'm effectively giving control to somebody else. You have to have the right personality to be able to give up control to somebody else and be comfortable with it. And also, if you do something actively, theoretically, you make more money off of it because some of your time is going into it. So you have to be comfortable with the fact that as a passive investor, your returns are going to be slightly lower than if you own the building directly yourself, right? So just some thoughts.
No, absolutely. And for me, just quickly touch on that. I know you have a few questions, a lot of questions, Ava, but just to touch on that, this business model that you're speaking of being a passive investor and having the active investor managing the asset and putting their time and effort and expertise is the same business concept that institutional investors use to invest in private equity. Lots of large investment firms were the active investor, if it's through M&As or other types of venture capital or other companies. The institutional investor, like the pension funds, larger funds, family offices would invest with these large investment firms like the Blackstones of the world, and the Blackstone then would be the managing partner, and they would be the GP in that equation. So you are using, as an individual, what institution have been using for decades. So just want to kind of highlight that.
Yeah, you're 100% right. And I consider myself a tiny family office for my own self and my family. And I'm not nearly big enough to be a proper family office with multiple employees and stuff, but I'm doing the exact same thing. And you're exactly right. It's precisely that. It's just making bets on other people, other businesses. And, you know, I love being a passive investor. I cannot picture myself doing anything actively. I don't think I like the tasks, but the next person probably would say the opposite thing. So that's why it's a really important thing from a personality fit, I think.
That's incredible. Jeremy, why don't we start talking about multifamily here?
For sure.
As August and I were in the business of acquiring multifamily assets in the US. Why don't you let our viewers know and ourselves know what interested you about multifamily?
Yeah, sure. So, you know, I've been investing in multifamily. So the one thing I should have mentioned before, I'm like hyper diversified. I'm in over 60 LLCs. I've been in over 100 easily over time. And I've been in over 30 sales in the last 3-4 years. And just because I do it full time, I'm in so many things. Multifamily is probably one of my top favorite 4 asset classes for the next 10 years for what I do. And then I look for more predictable cash flow. So as long as you're investing in really high demand, high growth areas, right, where everything kind of lines up correctly and the price makes sense, I just see demand continuing with the right manager managing the building for that type of asset class. So when I think of predictable cash flow, one of the assets that comes to mind is multifamily for me. And I have been investing in multifamily probably since 2008, I would think. I actually started in a couple of different asset classes and eventually migrated into others, and had some great success in multifamily. And there's a few things I love about multifamily. One is that you get a lot of tenant diversification. So in the buildings that I typically target, I normally target somewhere between 100 and 400 units for my investment. And I specifically target 100 units or more because I'm a huge fan of diversification to help reduce risk, right? So you can get all of that going into a decently sized opportunity. And if one person doesn't pay rent or moves out or is a problem, then it's not going to really put a big dent into your cash flow, which is a fantastic thing for someone like me. And look, everyone needs a place to live, right? And that's not going to change anytime soon. Nothing's going to disrupt that. I actually invest in mobile home parks as well. So, you know, I capture someone who really has to go down to that level or wants to be in an individual unit versus being in a building. But the bottom line is that multifamily is just there's going to be demand in it for a long time in the right area. And that presents the possibility of getting that predictable cash flow. There's a lot of different aspects I like about multifamily. It's really easy to find more deals because there's so many multifamily buildings in the US that the volume of access to deals is really helpful because it allows you to actually sift through a lot more to become picky, right? So if I want to invest in a self-storage opportunity in the US, which I also do, there's probably, you can imagine how many self-storage buildings are there for every multifamily building? Probably, you know, the ratio is like maybe 1,000 to 1. I don't even know, right? But that means there's literally 1,000 more opportunities to find an apartment building than a self-storage building. And for an investor like me who wants to be picky, that makes it better for me because I can actually be much more picky in what I'm investing in, right? Which is important to someone like me. So there's a ton of benefits to multifamily, yeah, and not the least of which, as you could tell right now during this pandemic, as we're reporting this in February of 2021, it's been very obvious that the US government and the Canadian governments have supported housing and supported people being able to stay in their houses. And this is one of those components. In the US, and I can't speak to Canada, I'm sorry, but in the US, I know that even state and local governments have been providing rent subsidies to tenants that can't afford to pay. That's on top of everything else that's been going on with eviction moratoriums and everything else. So there's been a lot of support for even landlords in that space indirectly like that. And so anyway, I keep going on, but it's definitely a great asset class.
Incredible. And that's what August and I, we go after the B class asset.
Yeah.
Where the government's going to support the kind of the blue collar people who I mean, if they can't pay their rent, the government will step in.
And last thing the government wants is people, everyday, hardworking people not being able to pay their rent because they lost their job due to the pandemic, and now they're getting evicted.
Yeah.
Those people are going to go in the streets and burn down the city. So that's not what the government wants.
Yeah.
And Jeremy, I was going to ask you, as such an experienced passive investor, what areas are you most interested in for the multifamily?
Areas meaning type of building or location? Or what do you mean by that?
Location, sorry.
Location. So, it's funny. The approach that I take here in the US, and I've been here only 20 years now, but roughly, or 21, I guess. But I've seen, because I've been in so many deals, I've traveled to 43 states, okay, between just personally and also most of it's frankly been for investing. And what I've learned about the US is that it's so big in terms of the number of cities and stuff and just the population that I actually don't have specific areas that I target. There's obvious ones, which is like the Sun Belt, because a lot of the population is migrating towards those areas and you want to be within the path of migration where it's coming. But what I've learned is that I avoid stuff that's very volatile. So cities like Los Angeles, where I live, San Francisco, New York, where the prices go up and down a lot because I'm looking for more predictability and more stability. So I don't want to deal with that volatility. But besides avoiding those markets and the ones that are obviously declining or reducing or just having reduced population migration outflow, that type of thing, I'm open to anything. Because what I've learned about the US is that there's a ton of good places to invest. And so I don't say, look, I'm only going to invest in these 5 cities, even though they might be really good cities. I actually work the other way. It's like, what do I not want to invest in? And I'm open to anything else. So again, I don't have target cities, but I would say the most obvious ones are where the population is moving to. And in the US, that they're moving south. And that's the Sun Belt for the most part. And obviously there are some exceptions. And I think there's going to be a lot of pickup. And also there's a retiring population here too, which is also very good for multifamily. Because a lot of people are going to downsize. They're going to have to sell their home because that's the single biggest asset for most people in the US is their home and the equity in their home. To unlock it, they can either do a reverse mortgage, a couple other things, but very commonly they'll sell their house and move into either a condo or an apartment, right? To downsize. And so I think the apartments are going to pick up more traffic from that too over time. And that's actually really projected to start to increase in around 2023 here, as far as the age at which people are really getting to the point where they're going to do that. So at least from the data that I've seen. So
baby boomers, no, for sure.
Definitely. And you mentioned that you traveled a lot. Do you go and visit do you go and scout the assets that you want to invest in? Do you go visit the property before you invest in it?
I do. I try to. Usually it's more of a scheduling conflict problem if I can't get out there, or if it's a manager I've invested with many times, it's a really easy deal to get your arms around. I may not travel. And in fact, it's funny because I find multifamily is really easier to get your arms around than a lot of other asset classes. So for example, if I have to go evaluate a self-storage deal or a mobile home park deal, I really want to get a better sense of the location because that can really make or break the property. Whereas if you're in a dense infill area in Arizona or wherever you are, right, and you're just one of hundreds of apartments in an area where there's a lot of population, you can rent some rent comps, some sales comps from afar, walk the street, and short of like the manager, depending on the manager to inspect the actual building and the condition of the building and the rent roll, you're not going to glean as much by landing there and seeing where it is because you can really tell from afar. It's a little bit easier. But in general, my rule of thumb is I try to get out to actually walk the property with the manager at the same time. I can obviously do that because I do this full time, but there are exceptions for sure.
Amazing. And now we're sponsors. So can you tell us a little bit about how you found those sponsors that you wanted to partner with, what you loved about them, and kind of touch on that?
Sure. I would say that, in my opinion, overall as passive investing, the number one most important thing is who you're making a bet on. And the number two thing is the property. And the property is a very close second. But I think who you're making a bet on is really, really critical. They can make or break everything. I mean, I'll give you an example that I hope people in Canada can relate to. For those of you who've been here to LA, I tell people, like, I can invest it in the best property on Rodeo Drive, which is like the most high-end area, right, in LA and Beverly Hills, on the best block of it, where all the high-end brands are, in 2007, and been completely foreclosed in 2010, depending on how it was managed. And I could invest it in the worst building in 2010 with like, you know, the best manager, and maybe done better. So it totally depends on how the things can be managed and getting through some of the challenges. And you're completely relying on the manager to do that in terms of making a bet on them. So it's really, really important that you're very as picky as possible on the sponsor. And what I like to tell people is, from a high level, is that I try to make bets, and it's just a personality fit for me, so it could be different for other people, but I try to make bets on sponsors who are both experienced, obviously, but conservative, who are under-promising and over-delivering purposefully to try to build long-term relationships with investors to get them to reinvest, versus sponsors who are using very aggressive numbers and who are over-promising, who have the possibility of under-delivering, in that, let's say if they have a really good capacity to raise funds, they don't really care as much about whether you reinvest. They're just going to go on to the next investor. So I want to be on the same page philosophically about someone being conservative. And one of the ways you can actually tell this is not just in discussions with them, because you can get that too, but you can look at some of the projections and really tear into like what type of projections have they used. What does that tell you about the sponsor you're investing with? There's a lot of reading between the lines that has to take place as an investor to sort out who you're making a bet on.
Yeah, absolutely. And other than the sponsors, now I'm curious, other than the sponsors that you partner with, they're showing you deals, kind of deal flow that you can decide if you want to invest in. How else do you find deals?
Well, what I would say in the end of the day, to me, it's all networking, right? So whether I invest with you guys or with another sponsor, we have to invest in some way networking. I think I actually met you guys online on LinkedIn, possibly. I can't remember for sure. But the point is that every deal I've ever done that I could think of, I've really traced back to networking. And in the US, there's been some laws in the past few years that allowed for more public networking structure called the 506C for accredited investors to invest in, as far as the legal documents and the legal structure. So that's opened up a little bit of public marketing, but it's still really.
Could you explain the 506C on a high level?
Sure. Yeah, I'm not an attorney, but the 506C is basically the structure that is an exemption in the US that allows you to not have to register your shares as a public company and remain a private company, but allow you to raise funds essentially still from private investors. But the 506C was, I think, passed in the Jobs Act, and I think came into effect around 2015. I think it was finally passed. And what it allows sponsors to do in the US is target, if they advertise only to accredited investors publicly, and then every investor has to fill out what they call a third-party verification accreditation, meaning that there's now independent services where, in order to verify that you're an accredited investor, you have to submit documents to them. It could be showing you have, because the criteria for an accredited investor in the US is you have to either have made 200,000 single or 300,000 joint for the last 2 years and expect to make those amounts again this year, or you have to have a net worth of $1 million or more, excluding the value of your any equity in your primary residence. So you actually have to prove that up. When you do a 506C, the sponsor is going to require you to actually prove it up and provide documents. It could be a brokerage statement of $1 million or more in stocks. It could be your tax returns for the last 2 years showing you actually made that much money, but they actually have to get documented proof. The only way you can get around that is either if you are investing from an entity that has more than $5 million in assets, or, and you can prove that, or if you get a letter from your accountant, your attorney, or other advisor or financial advisor who is licensed, saying that they know you and you're an accredited investor and attesting to that. And that's actually not as easy as you think, because a lot of accountants and attorneys, like my accountant, will not sign that letter, even though he sees all my financials, because he doesn't have insurance in the US to actually cover it if there's a problem, right? If it comes back to him. So even though he knows that, I mean, he sees my taxes, I'm gonna have a transaction that proves that, he won't sign it from a liability perspective. So that's what the 506C is only allowed to take accredited investors who have actually been third-party certified and verified that they're accredited. In exchange, they're allowed to be publicly marketed too. And there's some benefits as well for the sponsors to use it, even if they're not doing public marketing from a lower risk perspective from them. But it does cause hurdles for investors, because now an investor has to go and certify themselves and not just check a box on a form like we used to. So.
Got it.
Thank you for
clarifying that. No, for sure.
No problem.
You know, you're speaking about finding the right sponsor to partner with. And I remember listening to 𝗖𝗽𝗶𝘁, and he is a data-driven investor. who has he's an active investor, but and manages a investment company, but he partners with active operators for his deals. And he was talking about how he would choose the active sponsor is not a sponsor who's been in business for a long time and who's done more than 10 deals, and not a sponsor who just started and it's their first deal. He has this sweet spot between 3 deals and 10 deals, because people who are in that phase have done it enough to understand the process, but haven't done it enough to build enough equity to be very rigid. They work with a potential co-GP to come on board. So that was kind of his idea of the perfect active sponsor to active operator to partner with.
Yeah, it's funny you should mention that. First of all, I know Neil very well. One thing I didn't mention is I co-host a conference every year in it's in LA for investors. We have to do it virtually. It was just actually done in January, and Neil was actually our keynote speaker for one of the days. He is amazing. If you have a chance to go read any of his data, we had him present his outlook for 2021. Just a very data-driven guy, even in how he runs his business. And it's funny you should mention 3 to 10, because for myself, I normally like targeting, I would say closer to 7. I would say that sweet spot, and what I found is somewhere between 5 and 10 as far as my comfort level. So I won't do 3, and I'll probably prefer to do 7 to 10. But I think he's 100% right. Sometimes finding this right sponsor is a question of timing in terms of when you're meeting them. And I'll give you a great example. I've invested with a multifamily sponsor in the US who owns over $1 billion of apartments in Texas since 2008. And his investor base is so big that I can only see every 3rd or 4th deal. Like, no matter how good of a relationship I actually build with him, he's purposely, in 2008 and 2009, he wanted to acquire so much stuff, but he didn't have the investor base to do it because he hadn't really diversified his investor base. So ever since, he just purposely over-diversified his investor base, and now I can't see most of the deals he does, right? Because he's just too mature.
Are they getting oversubscribed? Is that why you?
Yeah. If he sent it, like, he can only send it to one list at a time because he has like 4 times. He'll be like oversubscribed 3 or 4 times.
That's a good problem to have.
That's a great problem.
Well, what he did was he purposely created the problem for himself so that in this next downturn, or whenever the next downturn is, that he can go and acquire stuff. Because when the downturns come and more investors get scared, he won't be able to get as many investors to participate necessarily. Right. So yeah, which he wasn't able to do in 2009 as a result. But my point, though, is that, he's a great experienced sponsor. I've invested with him like 15 times, or more than 15 times, I think. And I love him, but I can't even look at most of his deals still, So there's a lot of advantages to looking at younger sponsors, even beyond what Neil was mentioning, for sure.
And when you say you can't look at his deals because they're not being sent to you, and he's selective because he's got all these different groups of investors.
He has different lists that he sends.
Yeah, exactly. So I just can't do it because he can't. If everybody asks to see each deal, he's going to be 4 times oversubscribed. So he just compartmentalizes everything.
Got it. And then investing with a sponsor who has, let's say, for example, you use that 7 deals under their belt.
Yeah.
They're much more inclined to cater a passive investor coming on board and to take care of them because they are in that building base stage of the company.
Yes, you're likely to bet not only flexibility, you're going to get probably better terms, right? So you're going to get either better preferred return or better splits probably, because they're not going to have as much choice. They're going to have more flexibility input into legal documents and some requirements you may have, whatever it might be. There's definitely a lot of benefits to it. I agree with Neil for sure. It's funny, no one's ever mentioned that to me. It's funny because I never even talked to Neil about it, and I've always had it in my head about 7. And so it's interesting to see he's doing a 3 to 10. It's a very similar range. Yeah.
Yes. Yeah. And there, we are apartment syndicators, as obviously is a known phrase in the US. For Canada, that's a newer phrase. There aren't that many other apartment syndicators that are partnering with Canadian retail investors to acquire US multifamily assets in the regions that we are in. And that other company, we kind of modeled ourselves after them, but we wanted to kind of be better and be competitive for the Canadian investors. And that's what we're seeing as far as our fees and the back end splits is night and day of what we're offering. And I always say, I wish just the investors could see what kind of splits we're offering and what kind of, the fees that we charge, because the fees are usually not in the deal presentation. The fees are always in the PPM in your guys' version, or our version is the OM, offering memorandum. So the investors have to read this 80-page document to see the fine print about where those fees are. So, and we want to kind of bring a focus onto kind of the fees and the back end, and that's probably should be the aside from what you said, the team and the asset. Also, the next number 3 should be what are fees involved and what's the split on the deal.
And before we jump into that, I just wanted to, speaking of oversubscribed, the other company here, because it's so foreign in Canada, the syndication world, August and I were excited to start our company, because speaking of oversubscribed, the other company here who partners with Canadians and purchases assets in the US is oversubscribed. So we've seen
on every one of their deals.
On every one of their deals, sorry. So we've seen the need for that Canadians have for this alternative investment opportunity. And we bridge that gap now, where we've created a beautiful streamlined process where Canadians can invest through our limited partnerships and corporations and be relieved from double taxation.
We actually offered to file for get our accountants to file for our investors' tax returns. We just saw what is in place now for the other team that exists already, and let's do everything a bit better. So. We just had to plug in our company over here and be cheerleaders of CPI.
But it's really cool because Jeremy is huge into passive investing, and I'm going on a mission to educate my fellow Canadians. Hey, listen, you don't have to just settle for 4 or 5% annual returns on what's available right here. There's other options. Exactly. And look around the country and look around to see who can make that possible for you.
And we bring other sponsors on our show. Now they might be offering other investment vehicles to invest into, REITs, mortgage investment corporations, as they're called here, or other investment asset classes to invest into. But is for the investor to have those options and have those have those choices. You were going to kind of mention something on that 1, 2, 3, the team, the asset, and then the way I kind of put it, the fees that are involved.
Yeah, exactly. So, with the part we didn't get to is obviously who you're making a bet on, the property, and then obviously the terms, right? So it's going to be the fee splits and everything else. And, it's funny because one of the things I do personally to help weed out deals, the first thing I do as an investor is I look at some of the projections and some of the fee structure to see if it even fits in my box, right? Meaning, like, does it even meet when I'm looking? If somebody as an investor, if somebody was taking 90% of the profits, like as an extreme example, which I've never seen before, but it would just go right into the garbage, right? So I definitely filter things out very quickly from there. But to me, it's still more important who you're making a bet on and the asset than the structure, assuming the structure actually works for you.
Could you share with us kind of the fees that you look for,
or those numbers that you look right off the bat?
So here's the challenge with answering that question right now. So the way that I work high level, and not just apartments, but everything, is that I start a cycle. Once the cycle resets, I identify a minimum year one, because I'm a cash flow investor. So I identify year one cash flow target minimum projected, and let's say a 10-year average annualized projected cash flow. I don't even look at the total returns necessarily just off the bat, just to tweet it out. And then I'll have a minimum year one and a minimum total average annualized for cash flow in my head. And then in 2009, 10, 11, I'll start looking for those types of deals, continue to go through. And let's just say hypothetically, I'll give you a reality check. 2015, I don't know why I keep using self-storage because I invest in so many asset classes, but 2015, self-storage was not able to meet those criteria that I had anymore. And I dropped off that asset class, but kept investing with whatever was left. And so what I do is I'll drop the asset class off in that part of the cycle where it no longer meets my cash flow targets, except if there's unique opportunities, right? Because I'm still going to be open to all unique opportunities because they're out there. And then once all my asset classes are too expensive and that I can't get those cash flows, that's when I go into like end of cycle, sit on the sidelines mode, that type of thing. So right now you're catching me at the end of a cycle, but not yet at the beginning of a cycle. And I haven't been able to identify what I need to target for my next cycle as far as my cash flow minimums. So last cycle, I could tell you I targeted in Class B stuff in the US, 9% target average annualized cash flow year one projected. Sorry, not average annualized, projected year one cash flow, and 11% average annualized. Now, this was at a time when interest rates were much higher, cap rates were much higher, and that was completely realistic for a market rate deal. That's completely unrealistic now, just to be clear to everybody. And that's what I'm saying is that I'm going to have to readjust my targets for the next cycle because interest rates have come down, et cetera. But I'm not convinced that I fully understand how the cycle's starting yet. So I'm waiting to try to understand that better. So I don't have an answer for you because I'm in between. Is my very
and not to mention any kind of numbers, but as far as the metrics you look for, it's the year one cash flow that you look for, the percentage on that. What are the other metrics you kind of look?
Yeah, so those are just the cash flow targets, right? I think that's what you guys are asking for. But I look at certain preferred returns. So in the last cycle, I always target an 8% preferred return. Now that's become much more difficult to achieve potentially, and I'm not sure that'll be realistic for the next cycle. We're going to have to see, right? I look at the profit splits. I invest typically in more stabilized or minor value adds, and medium value add at the beginning of a cycle. So I usually will see somewhere between 50-50 and up to 80-20 splits, right, in favor of investors. 50-50 is if there's a lot of work to do and a very experienced sponsor, I can probably deal with it. But most commonly, I see somewhere between 80-20 and 60-40. And that's in favor of investors. So once or twice a year, I'll see a deal that is marketed as like 40-60 in favor of the sponsor. And that's the kind of deal that tells me I'm not on the same page with the sponsor. Like, I don't think it's market rate, and that just goes in the garbage right away, for example, where it's, if they're taking more than 50% of the profit, like an immediate no, right? And those are the really high level things. And then I'll start to dig into some of the other assumptions after that, but just really high level.
Yeah, just a quick question on that. So you have kind of the targeted kind of that 60-40 up to 80-20 range, or even 50-50 in some cases, you said, depending. But on the preferred return, could you briefly explain what are preferred returns? And if that is a metric that is a black and white, that if preferred returns are not offered on a deal, that you will not look at it. And the reason I bring this up is because most products in Canada don't offer preferred returns. And the ones that do are they're accrued preferred returns, which are paid after the project is either built or completed or sold. There is an element of preferred, but I'll pay you later kind of idea, where you're hoping that the sponsor gets there, not from the cash flow that's coming in from day one.
Wow, yeah, it's completely different in the US. So in the US, there are some sponsors who don't do a preferred return, and maybe those are very common, like an 80-20 split, just straight off the top. Okay, so it's a 20-80 in those scenarios very commonly. But most of the time, there's a preferred return in the US that actually involves the distributions as well as the back end split of the profits. And so what a preferred return does is, this is behind the management fees and all the expenses of the property. But as soon as you look at the profit that's distributable to investors, or this distributable period, how does that get portioned out, right? So when I say there's an 8% preferred return, what I mean is that the first 8% of capital, like the percentage based on what you invested, right? So that first 8% equivalent of what investors invested, of the remaining capital balance that's available, I should say, because there's investor, you can get paid down your capital back over time, and it's based off the amount of capital you have left in the deal. But let's just say it's year one, right? You got all your capital in the deal. The first 8% goes to investors, and then after that, it's split a certain percentage to the sponsor and a certain percentage to investors, and that's that 60-40 to 80-20 split we talked about. Now, there's two. I don't want to get too complicated, but there's two methods that can be used in the U.S. from there. Either that split can be had as a split between the sponsor. So if there's 10% cash flow and there's an 80-20 split, right, above the 8% preferred return, once I get my 8%, I'm getting 80% of the 2% that's left between 8 and 10%. So right, so I get 9.6, sponsor gets 0.4. Now, some sponsors choose to say, you know what, you're going to get the entire 10. We're not going to worry about taking a split of the cash flow, but that money that we're giving you above the 8 is going to start to pay down your capital balance. So in year one, at the end of year one, if I've gotten some money above the preferred return, now all of a sudden the amount of money I have left in the deal is lower. And the reason why some sponsors prefer to do that is because they're kind of like just slowly chipping away at how much money your basis is in the deal. And eventually they're going to get a full split with no preferred return once you get to zero, once you got all your money back. Okay. So it's up to the sponsor. It can be either way. And you have to check the legal document to see how they're handling it, because it actually really is up to the sponsor. It's not like it's done 90% of the time one way. It's actually, I would say I don't know if it's 50-50 necessarily, but it's common to see both. So from an investor perspective, what I love about preferred returns and why I do make it a black and white, to your question, I make it a black and white rule for myself. It's not about getting the first 8% for me. It's actually more about the downside protection. So let's take a look at a deal that for some reason had a problem in a year and maybe only distributed 4%, okay, last year. And I'm an investor in that deal, but it has an 8% preferred return. What happens is that the other 4% that they didn't pay, right, from the 8 that they couldn't make up, they couldn't hit that 8%, so they only paid me 4. That actually is now, it actually is taken over and goes to the next year, right? So now all of a sudden the next year they owe me the 8% preferred return and the 4% that's in arrears before they can start to take their split. So what it's doing is it's holding a sponsor more accountable to make sure that I'm going to get closer to my cash flow targets in the long run as an investor as a preference. They're giving me preference over those cash flow, which is why it's called a preferred return, to make sure that I'm going to get that minimum preferred return that I'm supposed to get, hopefully, in the long run. And that's really critical for me as a cash flow investor who lives off that cash flow, right? Because I'm dependent on the cash flow to live off of. So I want to make sure I do have that preference to the cash flow. And by the way, that preferred return holds through as well on the back end of a sale. They want to make sure that investors get their money back first, and then there'll be a split. That's typically even if there isn't a preferred return, but that's also another important component on the back end. So for me, I have a hard rule, and I would tell you that most of the deals I see in the US have a preferred return. It's actually rare that there isn't one, but it's not completely impossible, and it does exist.
Yeah, no, great. And my advice to investors would be, make a decision what type of investor you are first. If you'd like to invest in venture capital and invest in companies that might make it or have an incredible idea, and you can 100x your investment, great. That's who you are. That's the type of investor you are. But if you are an investor that looks for cash flow from day one, and also to participate in the appreciation, these multifamily assets are probably the best bet you have in real estate to be able to achieve those goals as an investor. And if that is your goal, if that's an investor you are who wants to participate in cash flow and appreciation, you need to have preferred returns. So I'll come out and say it on record. This is going to be posted on YouTube, that as an active sponsor, obviously I can't predict forever how we will manage and structure our partnerships, but as an investor, as a passive investor, if there is no preferred returns paid out day one, you should take a closer look at a deal. And my advice to you would probably be not invest in that investment. So again, there's caveats on that, but that will be my advice to anyone, even if I was talking to my own mother about investing in these type of vehicles.
Yeah, and I have to say, just to add to that, the good news is that most of the deals, at least in the US, have a preferred return. So like, to me, if you're not getting a preferred return, you're almost like not getting your fair share, or like what I call market rate or fair structure, right? Because you can get it in most places. So why would you choose a deal where you can't get it on necessarily, if it's going to help you and give you certain advantages if you can get it? It just seems like you should pass on the deals that don't have it.
For sure, for sure. Great advice. And to speak about I guess I want to kind of discuss about being investors, right? So the capital stack. There are different kind of types of investors involved in a real estate deal. The bank is in a way an investor. They sit at the bottom of the capital stack. They have certain their risk is it's about the risk that exists. So they sit at the bottom of the capital stack. The bank does. They're the senior debt, and any kind of income the asset makes has to go to your senior debt first. But right after or right next to the senior debt is, in some cases, is something called pref equity. And these are equity investors who come on board. They're not bridge lenders. They're not mezz debt, but they're investors in a deal that have to hit a certain return before anyone else in the deal, including the limited partners or the GP, gets any kind of profits. And then the next line after that is the common equity, which is the limited partners, and then next is the GP. Have you ever thought about that type of investing in deals, for you to sit on that pref equity stage, and where you just get in most cases you just get a preferred return rather than participating in the upside? Or kind of talk to us about any experience if you have.
Yeah. Do you guys offer pref equity in your deals or no?
We do. So we're currently on a large deal that we're looking at, but the pref equity, you have to, the way that our underwriter explained it to us in our modeling is that let's say we're doing a $20 million raise. Even if we have an ability to raise the $20 million from the pref equity, or a big percentage of it, the issue will be that the rest of the investors might not hit that preferred return you're trying to hit them, because most of your cash flow is going to feed the preferred equity portion. And excuse me if I'm kind of using the wrong terminology. So a portion of we are looking to possibly make available a portion of our investment as pref equity for pref equity investors who come on board.
We do the math and allocate a certain.
Yeah. So come on board. Like for currently on our deal is a $27 million raise. And we on our current model, we've allocated $7 million on the pref equity tier for investors to be able to invest in that, but a minimum investment of $1 million, for example.
Okay, got it. So there's a lot to cover on this topic. I think it's a very important topic. And my biggest concern with this topic, to be told honest, and I was just on another podcast yesterday actually talking about that too, is that I really don't believe that investors fully understand when they invest in preferred equity or common equity, I don't know if they understand the capital stack and the risks or whatever that you're talking about right now. And I think it's really, really important for them to understand. So I have invested in a couple of pref equity deals. I generally don't, and I can explain to you why, but the ones I've done have been highly unique, unusual, and not what you guys are looking at right now, in that I'm always honest. So I'm going to be honest again. My opinion is that pref equity has popped up in the last 2 or 3 years, because really, if you were investing in the US in 2012, you wouldn't find pref equity typically in an apartment deal. But it's popped up in the apartment deals recently as a result of the lower cap rates, meaning that the cash flows are lower, in order to be attractive enough for some investors to want to participate in terms of the cash flow. And so the pref equity can be a really good solution for someone who's looking for cash flow. But there's a lot to consider too. So I 100% agree with you. The common equity holders are more at risk when there's preferred equity. And that's actually one of the reasons why I don't invest in preferred equity deals normally, because I prefer to be in the common equity just for myself. Everyone's different there, because when you go and explain it to your investors, like, there's pros and cons to being in each. So, you know, it doesn't, just because I only do common equity doesn't mean it doesn't make that may be the opposite for somebody else, right? So, but I don't like the concept of being behind more preferred equity, because when I go into a deal, I look at the loan to value of the bank that we talked about, and I'm trying to target 65 to 70% just for my own comfort level. Everyone's different. And then if you put preferred equity ahead of me, now it's not really 65 to 70% anymore. There's more people ahead of me, right? I'm not getting my pro rata share, to your point. And so I have more risk as a common equity holder when there's preferred equity holders ahead of me. Am I going to get compensated? Is there anything in the deal that's making that make sense versus a deal that doesn't have preferred equity for me on the similar building somewhere else, right? So that's a big concern for me personally.
That's your view as a passive common equity investor.
Yes.
When you're coming into a deal, you want to, and if you see a pref equity investor involved, then you say, hey, is this going to trickle down to me? Is this kind of, waterfall is going to eventually hit me? Or are these guys now have promised a pref equity return to certain investors, and us common equity folk are not going to be able to get any of the pref return or cash flow coming to us?
Right. And so sometimes what results is that, if you think about it, every time they're giving up a portion of units in preferred equity, they're not participating in the back end profit. So as a common equity holder, what I can do is maybe get a total higher return, because there's less equity that's being diluted into the deal. But I don't invest for that. I invest for cash flow. And so I don't want someone to be ahead of me on the cash flow. I don't care if I get the higher back end. That's not what I'm looking for, right? I mean, it's great, but it's not my personal goal. So it's important to understand, and I'm glad you brought it up, because that's why it's challenging for me. There's a lot of things I could talk about on this topic. I look at it as a common equity shareholder, almost like a cumulative loan to value ahead of me, right? So it's like almost like you get a second position loan, but it's not there. You just have a preferred equity stakeholder. So part of the problem in some of the way these deals are being structured, to your point, is they're taking a lot of preferred equity. And when they take too much, I've seen some deals that would have made the effective cumulative loan to value of 75% loan, right? Loan to value, actual first position loan, another 13% of preferred equity. And I'm literally like 88% loan to value trying to get paid behind them on a cash flow, like equivalent, right? So to speak, in the way that I see it. It's not true, but it's the way that I see it. And so that, if I can't get so much more return on the back, like something's got to basically make up for it, and it usually doesn't, from my perspective, for the common equity holder. So that's an important consideration. The reason why I don't typically invest in preferred equity on that stack is because I typically target stuff that's really stabilized.
That's perfectly that's cash flow right there. You're not even caring about the back end. My understanding of a pref equity investor is the person that just cares about cash once right after the senior debt. So in my mind there's a lot of people, and sorry to quickly interrupt you here, but a lot of people here in Canada do private lending, like being a bridge lender or mezzanine lender as an individual who'd partner with intermediaries like mortgage brokers to do private lending. So I'm like, hey, and they're happy with it, with a 7%, depending on the risk. But I'm like, hey, this would be a perfect product when you're investing in a large $50 million asset, when you're sitting right after the senior debt, and you're getting the great returns that we can offer in the US, the 8+%. So kind of talk to us about, as a cash flow passive investor, why is it that you're not as excited about being on the pref, as you were saying?
So, well, actually, I do hard money lending myself. So the hard money lending in the US is essentially when you're lending on like a flip of a home or other types of lending, but that's what I do. And I'm actually the first position loan, right? But typically I am in at a very low loan to value. It's going to be 50, 60, 70%, and I'm making 10% interest, right? So that's a different story, because it doesn't mean I'm going to put all those eggs in one basket, even if it's a really good return, right? So, and by the way, there's all kinds of risks associated with that that's not associated with apartments. So it's just totally different. But I only mention it because I do hard money lending as well, just so you're aware. So I'm familiar with that. But on the preferred equity side, you would think it'd be the perfect fit for me, to your point. But where I have issue with it is that I'm already investing in a really low risk type of profile deal, which is already stabilized, could even be 100% occupied, right? So if I'm going to get this fixed return, but I'm not going to be able to benefit from the upside and the mortgage pay down and some assumed depreciation in the back end, I feel like I'm not really getting the full return I can get because I'm going in for a similar risk profile, right? But if I can get all common equity in a deal and have no preferred equity in it, then and it's already low risk, then I'm going to get probably a similar cash flow, maybe slightly lower to the preferred equity, but not that much lower. But I'll get potentially the back end at the back, right? So I guess my reasoning is that the difference between how much I'll make as a preferred equity investor and the common equity isn't great enough to make up for the potential profit in the back end down the road. Okay, even though I'm a cash flow investor, I just don't like getting that fixed return. I feel like my return, I feel like the operator is getting more of the return, and the other common equity is where I should be because it's already low risk. I don't need to be even more low risk than it is as far as my comfort level. So it's a risk reward equation for me, which the next person may completely disagree with because it's very subjective. You know?
Yes. So now let me twist it on you a bit. What if you had an option in a deal to be common equity and pref equity to kind of invest in both in the same deal? Is that something that because there are options out there? Are options?
Yeah, well, actually,
options we were looking at to
yeah, well, now that you mention it, I mean, I guess theoretically, if they're willing to take you, if there are two classes of shares, you can, as an investor, you can just do one unit of each, right? So that's actually interesting. I never thought about that. I'd have to run the numbers. I've actually, to be fair, I've actually not thought that through.
I'll send it over to you. There's a bit of a minimum investment on the pref equity side.
Okay.
It's higher minimum, but then it allows you to make that minimum investment. Let's say the minimum investment is $250,000 on the pref equity side, which not guaranteed, but has that 9% pref per se, and then on the common equity is $25,000. So it's a big difference. But then now so people can mix it up between both types of classes of investments that are existing. Yeah.
I would say this, like I thought about it a little bit as you were talking, and I think that if the world came to the point where it was only two classes of shares and apartments that I can invest in, I'd probably end up doing both, to your point, because that would be a better solution for me. But I think if I can only get the common equity still, I'd probably still go with that, because I still end up getting, to me, it just won't make up for the risk reward of not getting the upside when the risk is already low.
Okay, fantastic.
We have a question from one of our viewers here, and I think is a good question for this time, but from Graham.
From Graham, it says, is there typically much risk of the value of the property not increasing as much as projected?
Is that for me or for you guys?
Well, maybe for all of us. Not in the US for the last 6 to 7 years, I would say. It's all the projections have all been the opposite. Whatever people projected end up being more. But you know, I'll ask for yourself, Jeremy, to kind of touch on this as well. But obviously, all these numbers are projected in any kind of these security investments that investors are making is all projected. You're guessing. Even as an individual, if you're buying real estate and you're hoping on an appreciation, you're guessing of where the market is going, and that's why the trust in the general partnership to be able to be the right team to know where to invest and what are the metrics they're following to be able to invest. In our cases, we had an opportunity to invest in Canada, but unfortunately the metrics we were looking for didn't exist. We couldn't hit cash flow and appreciation, and the appreciation that existed was so fickle because it was to do with foreign investment, and something could happen in China and would affect the market here in our neck of the woods. Whereas in the US, you got over 300 million people. You got huge migration that's happening in the US from outside in. You got an in-migration happening from state to state in the US. So there was just so many reasons for us to look within the US. But all these numbers are projected. You want to lower the risk as much as you can when you're looking at the assets that you're investing into. And yes, there is a chance for the property not to increase. So yeah, maybe you can give us an experience on you as a passive investor. Was there a situation where the projections the asset didn't kind of go to what the general partnership had promised, not only on the appreciation side, because the appreciation is not really in the general partnership's control. It is about where they're investing. If they feel bullish about a certain region and they invest there and doesn't end up with what they thought, but as long as they're investing in the right city, in the growing cities, job growth, population growth, it should go the way. But walk us through the process of certain projections given to you as the limited partner, as a passive investor, but those projections weren't met if it was on appreciation or any other promises that were made to you for that investment.
Yeah, sure. And I just want to touch upon the question directly as well, just for 1 second. So I absolutely agree. It's all about projections, right? So as an investor, there's two things you can do to help reduce your risk of actually the deal not meeting the projections. One is that you can scrutinize projections and make sure you think they're conservative. Because I can tell you right now, there's a lot of sponsors out there who will use a lot of great numbers and not be conservative, and you're going to have a higher probability that they're not going to meet their projections, right? So that's like an obvious one that you can do to help reduce your risk, is to just make sure you're looking through the pro formas and think that agree that you're actually getting into conservative underwriting to try to meet those projections. The other thing you could do is think about timing. I think a lot of investors don't think about cycle timing and market timing. And I don't need to tell anybody here that if you bought an asset in the US in 2006, it may not have been the best time. And if you bought it in 2011, that's probably a better time, right? And that can make a difference in the projections, right? And that's just the market and cycle timing. So as an investor, I'd strongly recommend, even as a passive investor, you get a really good feel for the timing and the markets, and use that as part of your investing strategy as to what you invest in and when, in terms of what, those are going to help to reduce your risk if you get it right. So as far as deals, so I've been in plenty of deals to the point where I can give you a couple of examples. I'm trying to decide which one to give you, because and I don't have that many, honestly. I only have a few, but I'm trying to decide which one to give you, because there's a lot of reasons why I can give you 20 reasons why any deal can go wrong. I'm just that guy, right? Just because you got to know what your risks are. So it could be a fire, right? Burns down a quarter of your building. And by the way, the insurance doesn't pay. You have to fight them in court for 4 years, and you lose, and you have to pay attorney's fees, right? And then what happened? All the cash flow the whole time, right? And the income didn't come in from there, and then you had to foreclose because the income wasn't coming in because the insurance company wouldn't pay. So, right? By the way, that's not happened to me, but that's my point, is that there's a ton of these 1% risks, right? And when you invest in a Class B building that's mostly occupied, I like to call it like you're investing in a newer airplane. So in a newer airplane with new technology that's not gone through 30,000 cycles of landing and everything, you basically have to have like a domino of 6 things go wrong before you actually crash, right? Because if one engine goes out, you land. If one computer system goes out, you land, right? It's like, it has to be really bad luck of like 5 things going wrong. And this is another way you can reduce your risk in terms of so that's just going with the building that's more stabilized, et cetera. But there's all these 1% risks that can still get you in the end of the day. But I think I'm going to give you an example of one where like 5 dominoes fell. Okay. So I invested in a 2008 student, and this is the only foreclosure I've ever been in the US or Canada, because I also invest in Canada. I have in the past. And it was a student housing apartment building, 303 units, a first property across from a large state university campus in Michigan. And my thesis, it was in January 2008, I said there's going to be an economic downturn, but people go back to school in the US when there's a downturn. So there's going to be a lot of demand during this downturn. I'm not too worried about the asset performing during a downturn. Thesis worked out perfectly. We bought the building. It was like 99%, 100% occupied, just because of the location. And we got a really good deal because of a loan assumption and these loan terms. And the loan was coming due in 4 years. That I don't normally do, but I was comfortable with it given the basis. So 2008, 9, 10, 11 performs perfectly. Gets through a recession, no problem, like no issues, right? 2012 spring, a city sends a letter to all the tenants and the landlord and says, we have to close the bridge for repairs you have to take to get to campus during the summer, because it has to be done. The repairs have to be done during the warm summer months. But don't worry, it'll be open in time for school this fall. Like, don't worry about it. You can still live here. So our occupancy goes from 100% to 65% because people are like, I don't want to take the risk of being here in case the bridge doesn't open. Okay, because I got to get to school. So that was the first domino, right? And the interesting thing about that domino is that we were pretty much right around break even. We could have dealt with that for a year and moved on, right? But that was like the 1% risk that nobody can ever forecast, and it's no one's fault, and it is what it is. Domino number 2, our loan was due that fall. Okay, so it happened to be of all the time, our loan was due that fall. which meant that the property was going to get appraised on a 65% loan to value, which in any other year would have been 100%, sorry, 65% occupancy, which in any other year would have been 100% occupancy, right? So they go to appraise the loan for the refinance, and it doesn't work because the property value is too low, because cap rates have changed a little from 2008, and we've got 65% occupancy. So then the bank won't extend the loan for a year. That's the third domino, which is very unusual in the US because banks aren't in the business of taking properties back. They're in the business of getting paid on their debt, right? The bank wanted the property because it was so obvious that it was going to be 100% occupied the next year. The bank actually wanted the asset back to like make the spread. So basically you could have never forecasted this. We got foreclosed, and this is a really good lesson about who you're making a bet on, by the way. So we get foreclosed, and sponsor feels horribly, right? But not their fault. Very obvious, wasn't in the projections, no one's fault, 1% risk. It's one of the risks of investing in anything. Sponsor owns 17 other student housing properties, most of which they own themselves. They didn't syndicate, so just own them 100% themselves. They felt so bad that they actually had a partial recourse loan they lost a ton of money on. They had most of the money invested in the deal they lost some money on, and they, without any legal obligation, transferred us to another property they owned across from in Texas. It was the first property from another large state university in Texas. And they transferred all the equity over out of their own pocket because they felt bad for us. So I had a 1-year interruption in cash flow, and I'm still cash flowing on it to today in a 100% occupied building. That's a very unique story.
Wow.
Not only multiple dominoes to have to fall, but then who I made a bet on made all the difference in the end about where I am today with that deal. Now, I don't expect any sponsor to move us to another property ever again. I'm probably never going to get that again ever, right? But the more important part of the story was the first part for you, but I just threw in the second part because it's interesting. So
very interesting. Thank you for sharing that.
And now that was a kind of a force majeure situation that wasn't the general partners. Is there any experience you've had where the general partner actually did, maybe didn't make the best decision about certain items, or promised that they were going to do certain renovations, but didn't end up doing it? Was there something, kind of a neglect or a mistake that a GP made?
Yeah, so I was this is not multifamily, but this is single family. I invested in 2012 and 13, 2 single family buy and hold 5-year funds. So great premise. We're buying at the right time in the market, timed it perfectly. Prices are going to go up over time in the cycle. We buy 2 pools of properties with these 3 partners. And there was a set of 2 partners who were the on-the-ground operators with all the experience flipping and holding and renting. And there was like a back-end guy, kind of an IT guy, investor relations guy. They get into a partner dispute within the first year or 2. The 2 guys who are the operators get up and leave. And now the investors are left with this guy who doesn't know what he's doing. Okay. And I actually stepped in on behalf of investors, negotiated to get him out, and got the assets back for the investors and brought a new manager in because it was underperforming. We were having all kinds of problems. And then we eventually, the new manager put everything back to like a much better condition, or not condition, but got everything back on track is what I'm trying to say. And then sold the assets off within a year or 2. And our final total situation after 5 years was actually break even, which is funny because when you're investing in low risk assets that are cash flowing, that are stabilized, break even is really not good. Like, it's not a disaster. I want to be clear. Like, I was actually happy with the outcome. But as an investor, when you get your same money back 5 years later, it's no good because I have to live off the cash flow. We've been losing to inflation, et cetera, right? But that was a different example. It was more of a partner dispute example, but it also was a performance as a result example.
Right.
Great point. And yeah, I want to talk to you about the different kind of the idea of you are I would call you a full-time passive investor. So you need to write a book when it comes to being a passive investor.
Yeah.
If that's probably in the works or not, I'm not sure. But kind of it's a great time to be a passive investor because of how much product and how many teams are out there providing their services to you. For example, here in Canada, we talk closely to a team called 𝗖𝗣𝗜 Investments, and what they do is they have this crowdfunding platform where you can invest in their product with as low as $1, but it caps off at $1,500. And for example, for our product, our minimum investment today is at $10,000 US, which allows that inclusivity, which democratizes real estate investing, and people can invest into these larger larger products and reap most of the profits that are coming in. I mean, on a surface, you'd be a master at this idea. Doesn't matter what it sponsors you work with, the passive investor receives most of the profits that are coming in, no matter how you really cut and dice it. Even if you include the fees and the back end profits, is the passive investors that are receiving the majority of the profits. But yeah, I'm gonna kind of discuss that idea. It wasn't really a question, but now that and that's what we're trying to do, is to get in front of the Canadian investor, and we also partner with US investors as well, but getting in front of them through the YouTube channel we got, through what we call our thought leadership platform, to say, hey, there is this other way of investing in real estate without being an active investor. There is a way to be a passive investor, to have a basic understanding of how this works on a, for example, limited partnership setting where there's limited partners and general partners, and to invest in a deal. So we're really excited to be part of that, part of this kind of movement, the idea of democratizing real estate investing and all these different levels of being able to invest. I mean, we talked about all these tiers. So like we talked about crowdfunding, the kind of common equity of being able to invest as low as 10,000, accredited, non-accredited. Our group here, we partner with non-accredited Canadian investors. On the US, they need to be accredited, but in Canada, they don't have to be accredited. And then also on the pref equity, where you can invest a higher amount and just receive it. So it's just about the options that exist now. And then you have all these general partners running around, working to be able to cater to the passive investor. Talk to us about your journey, and has there been now more product? Do you have more options these days? Is there more groups that you can sift through to choose from? Tell us about that, please.
Yes. So yes to all of that. Truly, things have changed tremendously since I started. When I started in 2002, the way I was finding deals is I literally had to go network and go to in-person meetings, real estate meetings. And thankfully, I was in Los Angeles, so there were a lot of meetings. I was going to 2 or 3 meetings a week to build up the network. And I wasn't married, I didn't have kids. It was much easier for me to do that back then. Fast forward to the internet, that started to make things a little bit easier with some communication and stuff. But then in 2012 and 13, when they passed those laws in the US to allow for crowdfunding and even for the 506c public marketing structure that we mentioned, things started to get a little more opened up in 2 ways. There started to actually become these crowdfunding sites in the US, like Realty Mogul, I'm an advisor for here in the US. And the investor groups started to pop up. And the investor groups really started, I've had my group since 2002, but the investor groups really started to pop up in much more volume, probably I'd say in about 2015, if I had to really pinpoint it. And I think as it was a result of the concept of democratizing all of this was starting to get some traction from a crowdfunding marketing perspective. And I think the groups kind of leveraged into it at the same time because people were becoming more and more interested in it. So there's been a big movement, especially since 2015, when there's been more and more participation in this. And I think it's just going to become bigger over time, to your point. I actually think it's about to take another step up, to be honest, in the US, in that what's happening in the US is that, I don't know if you guys are familiar, but some of the crowdfunding laws, one of them called Reg CF, right? So there's Reg CF and there's Reg A+. If you go into like equity crowdfunding platform for startups in the US, not for real estate, they use these 2 types of structures those were also passed in 2012. And Reg CF allows you currently to raise up to 1.07 million. It makes it really streamlined, really simple. Okay, and you can go onto one of the platforms in a public advertising, but to non-accredited investors. That's the difference.
1.7 in total of the raise you're doing.
Yes, 1.07 actually.
In total of raise.
1.07. Yes.
In total of raise that you're doing for.
Yes. But what's happening now is there were laws that were proposed and are being finalized by the SEC to increase that to 5 million. And I think it's going to be finalized in March. It would have been finalized in January, but President Biden came in and put a bit of a delay on just a review of it. So if it gets finalized, you're going to see that all of a sudden, if sponsors can go onto those platforms and raise up to 5 million, it opens up a whole new world of really being able to buy a building that's up to, call it, $20 million in value. Whereas right now you can only buy one up to $4 million. Well, that difference is actually the space that you and I are talking about today, right? It's those buildings that are 100, 200 units. So I think we're going to see a step up once those rules get final. I think people are going to start testing it in the US. The sponsors will start testing it. And if they have some success, you're going to have even more accessibility to it, right? And I think in the long term, what we're going to see on those platforms is those shares will become freely tradable on stock exchanges, smaller stock exchanges that will enable investors to be able to sell their ownership shares in those properties.
We currently have that available for our product. It's currently not active, but it's in the process of being active. Our exempt market dealer that we've partnered with, Token Funder, has created a process where the securities are digitized, tokenized, and allows for a secondary market for those securities to be traded.
Yeah. So that's actually possible in the US right now too. But the difference of what I'm talking about is you won't even need to tokenize it. You'll actually just be able to have I'm blanking on the word, but the company who owns the stock exchange could be the transfer agent who also monitors the shares, and they can literally just take the entire shareholder, God, the words are not coming to me, but the list of shareholders, and without having to tokenize it, just the next day they'll have your list already and you just put it up for sale on their stock. So it's a similar concept, right? StartEngine.com in the US, which is I think the largest equity crowding startup platform in the US, it just launched their own stock exchange for that purpose, not for real estate specifically, but just for startups to be able to trade your shares in startups. And I think it was October. I'm one of the initial investors in the company, so I'm not here to plug it. It's just I'm very familiar with it. So if anybody wants to go see what that looks like or it's going to look like, they have their own stock exchange up there, and it's probably going to be similar to what you guys are doing. But I think that's going to be the future in the next 5 to 10 years. I think it's going to take a while to get enough demand, enough volume of transactions done, so that if you put your thing up, there's going to be a buyer. That's going to take time. But I think that in 5 or 10 years from now, that seems inevitable to me. And that's really exciting for us as a passive investor, because it just gives me, me and other investors even more flexibility, more reason to even want to invest in this, right? Because now we have liquidity. I was telling someone the other day, my single biggest challenge in what I do, because I'm all in on this, is just a lack of liquidity. Whether it's a startup I invest in or cash flow or whatever it is, it's a lack of liquidity. And that problem is, I think, going to be solved probably in the next 5 to 10 years.
Making real estate investing and real estate liquid. That's pretty cool concept.
Look at that.
Yeah.
Hey, we're well over our hour kind of time that we had. We can talk to you all day. We would like to talk to you again, of course, have you back on, and possibly maybe we can have you to be sit on our board of advisors, because it's very important for a company like us to get a perspective of the investor kind of idea. And that's kind of the disconnect that a lot of time happens between the general partners and the limited partner. The general partner is always so go on scaling their company and their focus on the revenues, that they forget about the catering and taking care of the investor. So it'd be great for somebody like yourself to kind of play that advisory role and kind of advise us and point us to the right direction. So we'll love to discuss that with you as well in the future. I'll just open it up quickly. If anyone has any questions, this is not our regularly day, so we might not have many questions on today. And I think we already had those questions. Yeah. So we'll just wrap it up.
Of course. Before we wrap it up, just
Sure.
let me ask one
Okay,
question that I love to ask our
ahead.
guests. Jeremy,
Yes.
what is your number one best advice you would give to a passive investor?
God, number one is tough. I'm going to give a couple of very quick ones.
Sure. Go ahead.
Like, pay ultimate attention to who you're making a bet on.
Yeah.
Understand the market timing, and what you're investing in, and whatever asset class you're choosing, if it's apartments or other, make sure you really understand the deal you're getting into before you get into it. Like, spend a lot of time learning before you jump into something, so that because once you give your money to the sponsor, they have full control. So we talked about that. So just make sure you take enough time to learn at the beginning to be quite confident in what you're about to invest in, and feel like you've been able to vet the deal to the point where you think it's a good deal. If you're not sure if you're investing in a good deal or not, you may want to take a little more time to educate yourself before you go into it, because it's very liquid at the moment, right? At the moment anyway. And you're locked in and you have very little vote. So it's important to understand what you're getting into.
Great advice.
Well said. And then the next question, I guess it would be what is your advice to active investors, to active operators who are either starting out into the business or actively involved? What would be your advice to them?
From my side of the table, I'd say the number one piece of advice is a lot of sponsors like to focus on operating the property. That's what they do. That's why they're in this, right? That's their business model. And investors can be a distraction to them, almost like a pain in the ass, right? Because they want to deal with the property, they want to buy and sell. That's what they want to do. That's what they like to do. So if you're that type and you're just don't enjoy the investor relations experience, you don't like dealing with investor questions, which from my perspective is somewhat understandable, right? Then consider hiring an investor relations person who actually can dedicate towards that, if you're big enough, that who actually will be able to spend more time to it and not find it to be a pain in the ass. And the other thing too is that just make sure your reporting is at least, similar to what others put out, if not better, because I've been in some deals, which is crazy to say, that have significantly outperformed their projections, but the communication and or reporting is so poor that you're like, I hate to say this, but I literally cannot invest with this person again because I can't deal with the lack of communication, for example. Whether it's a response time, And that's all solved if you have the right investor relations person, right? And it's crazy to think that, right? But sometimes like a deal can literally bring out a negative experience for an investor, even if you've gotten an amazing return because of the lack of communication.
Wow.
That's the one piece of advice I'd have.
Great. And how about a portal? Now that brings up another question. We're not going to let you go here, Jeremy. How about
Let
a
the guy
portal?
go, okay?
How about an investor portal? What would you look for? Sponsors or teams that have, for example, an investor portal where you could go into and kind of receive information. All your, all the legal documents are on there. The quarterly reports are in the portal for you to view. Is that something?
I give or take a portal. Everyone's gonna have a different opinion. A portal is great, but it does I only get a report quarterly typically. And I'll get a check whether there's a portal or not. So it's not so hard for me to go back into my emails and sort them, or maybe to put them into a folder, right? It's very good I think for the sponsors, it makes their business much more efficient. In the US, just so you guys know, CrowdStreet is the most common white label type of portal. CrowdStreet's actually a crowdfunding site, but what they've also done is they will go and actually provide you with your own portal. And the cool thing about CrowdStreet is that it's become so common that if you were a sponsor who was about to invest with you at a CrowdStreet backend portal, it's not branded CrowdStreet, it's with your own brand. It's their technology. My password there's one password and it basically is the same across all the CrowdStreet. So like I wouldn't even have to set up an account with you guys. It'd already be done, right? Wow. You're not even starting off because they're already getting the information. But it's probably the most expensive solution, but it's the most common one I see people use. There's a couple others out there too. So I can give or take a portal, to be honest. It's fine either way, but it's becoming very common for sponsors because it's a really good cost benefit type of equation for a sponsor.
Got it. So what is that kind of channel of communication that you look for? Is it a phone call from somebody from the executive team once in a while? Is it taking out for dinner? Like what is that communication?
No, not at all. It's a quarterly report that has enough meat on the bone that we really understand what's going on. And I know that's very subjective, but that's just kind of the high level. And if you send an email to the sponsor with a question, you either want to hear back from them in general, or you want to hear back from them, say, within 3 business days, whatever is reasonable, right? Some sponsors are just not set up to be able to handle that, or just don't make it a priority because they're in the middle of 2 other closings, right? Which I understand why that'd be their priority, but in which case they should have an investor relations person. The biggest downside risk from a sponsor perspective is really more it's actually either the reporting is so flimsy you can't understand what's going on, even if it's going well, right? They just haven't provided you with enough information, or you have the odd question here and there and you're just not getting someone to answer you, or you have to email them 3 times to get 1 response, right? At some point, depending on how many questions you have, how many deals you're in with them, it becomes challenging. So that would be a really bad reason for investors to not invest with a sponsor again, but it does happen. But it takes a bit of an extreme situation for that to happen. But I could think of 2, 3, 4 just off the top of my head that I've invested with where that's actually been the case.
Okay.
Okay. Awesome.
You are a wealth of knowledge. Thank you so much.
Thank you so much. Thank you so much, Jeremy.
Oh, no problem. Hopefully this helps your listeners.
Glad that we made an exception and did it on Tuesday for Jeremy.
But I told August we have to have Jeremy on our show.
Absolutely. We got to have him on again. So really appreciate that. Are you on Clubhouse by any chance?
No, I don't. I got the message from you guys. Thank you. But I have an Android phone, and I don't believe they've still. I mean, last I checked a month ago, there was no Android app. So which is
not yet.
Not
but
yet.
It's coming out. I'd love to have you on there in our rooms on Clubhouse as well. So. Hey, again, really appreciate your time. Thank you for doing this. We'll see you soon, and we'll chat with you shortly.
Thanks, Jeremy.
Sounds good. Well, thanks again for having me on.
All right.
Of course, Jeremy.
Thanks. Bye, everyone.
Thank you, everybody, for coming today.
Bye-bye.
Bye-bye.